Interest rates have you spooked? This year, interest rates have more than doubled, and most buyers have found their buying power diminished and the potential mortgage payments increased as a result. What can you do? You can ask the seller for a rate buy-down. A rate buy-down works as a seller concession. The seller would buy down the rate to lower the payment for the buyer. It can also be for the life of the loan, or more often, for the first couple of years, say 2 points for the first year, 1 point for the second year. It will lower your payment for as long as a buy down is in effect. You'll need to qualify for the final interest rate, but it can help you ease into your new home with a more reasonable budget, at least initially. You can also buy down the rate yourself, known as buying points. It will cost you a bit up front, but will decrease your monthly payment quite a bit. Ask your lender about your option and the cost up front. Not all lenders are the same. Check with your old bank, a credit union, an online lender to suit who will offer the best rate. Depending on your needs, a mortgage lender may have a great program that fits with your requirements, so it really depends on your particular situation. But it's not a bad idea to shop around. Once you have some quotes in hand, compare your options and negotiate. Lenders may try to match or even beat other companies to win your loan. Rates had been lower for a while, so it may be worth asking if the seller's loan is assumable. Government-backed loans like VA, USDA, and FHA mortgages do allow them. Conventional loans, which make up about 65% of existing mortgages, do not. It will take longer to process, up to 90 days, and you'll probably need more cash to close, depending on the amount of the existing loan. It's not for everyone, but it can work nicely if the pieces fit. You can also make a larger down payment. Generally speaking, a higher down payment will net you a reduced interest rate. The rate is less for the lender. If you can swing 20% down or more, you also eliminate private mortgage insurance, which adds more to your monthly payment. You can ask your lender for various scenarios so you can see which one makes the most sense for you. You can consider an adjustable rate mortgage, government-backed loan, or a shorter term. If you think you'll be in the home for less than 10 years, you may want to consider an adjustable rate mortgage. The rate is usually 1% lower or so. It has the potential to increase, of course, so be sure you can afford the higher amount when the time comes. FHA and VA loans typically have lower rates than conventional mortgages, so it may be worth to check if either of those loans could work for you. Also, a shorter term loan, 10 or 15 years say, have lower rates and save you on interest in the long run. However, the monthly payments are much higher, so if saving on a monthly payments is probably not the best option. Whatever you decide, remember that mortgages can be changed down the road if interest rates improve. By buying now when people are hesitating because of higher rates, you'll probably pay less. There'll be less competition, and instead of paying $50,000 over asking to get the home you like, people were doing in 2021, you can probably get it for asking or with some concessions, making it a much better deal overall. And remember, a mortgage is not forever. It can be changed down the road if interest rates improve. There's a saying in real estate: marry the house, rent the rate. Find a home that works for your family now, make improvements to increase the value, enjoy the tax benefits, and look to improve the mortgage rate if rates drop again in the future. Contact me to start your home search today.